I don't know how long you'll be dead, but I guarantee it'll be a lot longer than you'll be alive. Hey, what's up? I'm Russ, and I've been dividend investing since 2018. So in this video, I'm really excited to share with you the most important things that I've learned after 5 years of being a dividend investor. The first thing I've learned is that time is running out and you really just need to start. Write down why you are investing and look at this often. Don't worry about changing your goal. Just set one and follow it. This should help to guide you on some of those tough decisions when you're not exactly sure what to do. Now, getting those dividends to start rolling in does take time. What you can do is focus on investing in quality businesses. Remember, these are not stock tickers you're buying, but an actual company making money. Well, let's hope that they're making money, and if not now, when do you think they will? Buying individual stocks is risky and time-consuming to find the right ones. If you don't want to do that, you can buy a basket of stocks in one shot called an ETF or exchange traded fund. But going the ETF route, while fine, will not teach you anything about business analysis. Or there's a third way, as my buddy Ryan Williams pointed out in this video, which is linked below, that you can buy both individual stocks and ETFs. There's no doubt about it, you will make mistakes and lose money. And this is okay. It's much better to get those beginner mistakes out of the way when you have less money at stake. And as Zig Ziglar said, failure is an event, not a person. If you've gained any new knowledge or experience, this is great news for your future success. Plus, money is the most renewable resource on the planet, and you don't have to make it back the same way that you lost it. John Wooden says all life, and I'll add investing, is peaks and valleys. Don't let the peaks get too high and the valleys too low. The stock market as a whole always recovers and goes up and to the right. I've also found out that the stock market likes to give us second and third chances, but we just don't know when that is. Nobody knows what will happen because nobody's seen this movie before. Famous people on the internet influenced me to make some changes in my investments. I sold stocks that were for my retirement savings and used the money to buy gold. I also sold all my shares in Tesla back in 2019, and I also bought 3M stock when it was worth more than $200 a share. I didn't do my own due diligence and I made investments on the convictions of others. The smart thing is to use the convictions of others for idea generation, which then you investigate on your own. But it doesn't have to be all by yourself. Websites like YouTube, Twitter, or Seeking Alpha have awesome investing communities. And the Seeking Alpha articles are great, but the real joy is in the comments. You'll learn an incredible amount of great information while getting a laugh or two. By the way, I have an affiliate link for Seeking Alpha in the description below where you can get 59% off your first year or just hook up the free trial and check it out. Learn something new every single day and build a solid investing foundation. 2 books I cannot recommend enough are The Essays of Warren Buffett and the Interpretation of Financial Statements, which I have the Amazon affiliate links in the description below. Don't chase yield and fall into a dividend trap. That's when you buy a stock only because it has a really high dividend yield. If the company cuts the dividend, everyone might sell and you're left holding a stock that is worth much less. It's better to buy a solid company with a lower dividend that will grow much quicker. And in my experience, I've discovered that a higher yield means a higher risk. But some stocks intentionally pay a high dividend. We'll have more on this later. And if you're enjoying the video, hit that like button like it owes you money. Reinvest your dividends, and you can do this in one of 2 ways. One is to DRIP or dividend reinvestment plan. This means if a stock paid you a $5 dividend, this will automatically be invested right back into that stock. This forces you to buy less stock when the price is high and more when it's low. Or the way I like to do it is to let the dividends pile up, mix them with new cash, and then target buy stocks that I think are at a better bargain. For many years, I was against used BDCs, or business development companies. But it turns out I didn't fully understand how they were constructed and functioned. So if you want a crash course into 2 really well-built BDCs, click the floating little box next to my head and I will tell you all about it there.